Okay, welcome back from the break. My name is Derek Laliberte. I'm an analyst covering primarily investment company and media stocks at ABG. And it's with great pleasure I introduce the next company, NAXS. And with us from NAXS, we have the investment advisors from NAXS Partners, Amarie de Porret and Thomas Åkerman. So with that, please go ahead with your presentation, NAXS.
Thank you. Good morning. So today we're going to talk about private equity. And no matter what, where you get your information from, whether it's from the web, TV, or the newspaper, every day you're going to see those headlines. Private equity fund has raised a major multi-billion fund. Private equity manager has sold a company for several billions, generating like 20 times the returns, like Nordic Capital did recently with Binding Site, or a private equity manager has listed a company on a stock exchange. So I think as a retail investor, the question that one asks oneself all the time is, how can I invest in those funds and be part of this industry and the fantastic returns they are generating? At the same time, whether you are a retail investor or a small institution and you have a long-term view, you're going to think carefully how you allocate your asset and build a portfolio. And I think it's safe to say that the most successful asset allocation models in the last decades has been the one from Yale Endowment, which had generated extraordinary returns by any standards. So over 20 years, net of fee, the Yale's endowment has returned over 11% per year, even during very turbulent period post-dot-com, the financial crisis, and the COVID pandemic. And obviously, one of the strengths of the Yale model is that it has an allocation to private equity which is over 30%. So basically, if you want to create long-term returns, you will want to have private equity in your portfolio. And the big problem is, as a retail investor or a small institution, you cannot get access to those private equity funds, either because they require tens of millions of euros of minimum investment, or even if you have that money available, it's very difficult to access the most successful managers because their funds are almost oversubscribed and don't take in new investors. So when we thought about this problem back in 2007, we thought the best way to solve it was to create a listed share which provided access to private equity funds. And this is what we did with NAXS. So NAXS is a standard investment company, Swedish AB. Nothing fancy about it, a single class of share, very straightforward. It is listed on NASDAQ. The company has today over 5,000 shareholders. However, one will note that we have one shareholder who owns more than 50% of the stock, which is a US institution called QVT, and which has also a relatively large influence on the company. For example, they have nominated all current directors. We will note that QVT has been a shareholder in NAXS since the IPO back in 2007, so they've been here for a really long time. And NAXS has a very simple business model. We provide access to the best private equity funds with a focus on the Nordic region, which also happens to be the region in the world where historically some of the best returns have been created by buyout funds. And our focus is buyout funds. It's not by coincidence. I think that when we launched in 2007, we considered also venture capital funds. But if you take a long-term perspective, one will know that, especially in the Nordics, the return of venture capital have not been as regular and strong as the one from buyout. They've been much more volatile, even if those funds have had a very good run in the last few years. I think if you take the longer view, the performance is not the same. And buyout funds, for those who are not familiar with it, it's funds who focus on mature companies and take a majority stake. So they control the investment and they can make the changes they feel are required. And amongst the names you have here, I'm sure you're familiar with almost all of them, whether it's Nordic Capital, Valedo, Apax, and so on. And there are some names maybe are less familiar, like Mimir, or JAB Consumer Partner, even if it's a multi-billion fund in the case of JAB. But we can get back to that, and my colleague Thomas will do a deep dive into the portfolio. Yeah.
Right. Yeah. Some of you are shareholders, and some have been shareholders in NAXS. So you're very well acquainted with these brand names. You're also well aware of many of the portfolio companies that have been exited over the years. Names like Munters from Nordic Capital, Truax from FSN, and you all know, and you each day drink a cup of juice from Joe and the Juice, where is still a portfolio company among our funds. And it's we usually get the question after we made the presentation what we are looking for next, and then people ask what companies would you like to invest in. But just I'm quite sure you are clear about that. We do not make direct investments in Joe and the Juice. That's not us. We invest in funds, and the funds decide, they locate, they originate the deals, they do the investment. So there's a layer in between. We just provide access to the actual funds, and then they make the investments. A few words about private equity before we dive into the performance of NAXS and our investments over the last 15 years. A typical fund has a lifetime of about 10 years. 5 years, the first 5 years is to make investments, find companies and make the investments. And then after those 5 years, you've built a portfolio of maybe 10 companies. And then there's about another 5 to 7 years of exits. When you sell, you IPO, and that's when you read about it and you read about the returns. So they have a specific lifetime of, let's say, 10 to 12 years. After that, they cease to exist, basically. NAXS has overall made, in our current portfolio, we have exposure to 9 different managers. But these 9 managers, in total, we have invested in 15 funds. And the reason why there are more funds than managers, of course, is that once they have invested over 5 years, they start another fund and another fund. And take, for example, Nordic Capital currently has I think 7 funds running, investing or divesting. And we are in 4 of those 7 funds. So that's why 9 managers, several funds from some of the managers, and that adds up to 15. And I mean, sometimes we invest in Valedo, for example, in 2 of their funds, but not necessarily in the third fund, or depending on the capital we have available and how the performance have been. But the speed of some of these investments can be very rapid. Today, many of the funds invest their capital in 2 to 3 years, which is but when we started in 2007, it was actually up to 7 years because we had the financial crisis in between. But nowadays, maybe 3 to 5 years is the normal investment period. Overall, we provide a diversified exposure to private equity. 9 funds. 9 managers, 15 funds, and remaining in the portfolio is also 63 portfolio companies, including, yes, we can go. 63 portfolio companies, including Joe and the Juice, still in the portfolio. The performance of the exits that have been made since start, a total of 176 companies have been acquired since we started in 2007, of which 113 have been divested or exited. And the performance of those 113 exits is about 18% per annum IRR. And that's after deducting the profit share to the underlying funds. You know probably that they they take about 20% of the profit above a certain threshold. So 18% per annum, and just as Anne-Marie explained, the return from private equity buyout is rather consistent. We've been through pretty difficult times, including the financial crisis. We had not the crash, but we had a serious decline in, I think it was 2014-15, at least in the stock market. We have the current times, which are also rather tough. So I think it's fair to say that the buyout sector is stable and consistent. I mean, 113, and this is over 15 years now, that has been both investing and divesting. Some companies are held and generate a fantastic return already after 2 to 3 years. If we take, for example, Espresso House, you all drink coffee. Maybe you don't drink juice, but you drink coffee, almost all of you. I'm sure you've had an Espresso House every now and then. That was originally acquired by Valledo, and 2.5 years later, it was... Hercules. Hercules. And 3 years later, it was sold to JAB, one of the funds in which we were invested. And that was a fantastic return after 3 years. We were very happy when we saw JAB acquiring. We didn't know JAB at the time, but since then we have also invested in the JAB funds. So we are actually again exposed to Espresso House, but there it's a very small fraction of the total asset. Binding Site, on the other hand, Binding Site was originally invested in 2011, so it's been 11 years in the portfolio, more than 10 years in the portfolio. And Binding Site was the company that was on the front page with almost 20 times invested money, 20 times, and that's about 19% per annum in return for that one single company. Actually, we don't only do fund investments. We have something in our portfolio called direct investments as well, where we go straight to the underlying companies and invest. It's a small portion of our total investments, about 5% of our NAV. And the typical type of investment we make in this case is a so-called co-investment. We invest alongside the funds in which we are investors, like Keurig Dr. Pepper, which is a global leader in coffee and drinks, and I think #1 in coffee in the United States. We have invested directly into that company. We are also indirect investors in the company via funds, but we really like the company. So that counts as a co-investment or a direct investment here. Still, we expect this to be a rather small share of our total portfolio. It's really fund investments that we will be focusing upon. So how have we done? Well, when you look at the NAV, this is starting in 2012. We actually started the business in 2007, but then it was a rather flat development because we had mostly had cash for 5 years. And then, you know, the exit started and we started to pay dividends in 2012. And we've had a rather nice development of our NAV over time. It's been rather stable. We had a bit of a fall in the NAV development in 2020 when the pandemic broke out and the underlying funds, the valuations came down quite dramatically, as you recall, in March, April of that year. And also this year, which has been really tough. In Q3, we reported a 5.9% increase in NAV and 27% over 12 months, which is quite good given the rather rough times. Here it's worth mentioning that the NAV, which is the green part, the other parts are the dividends. The NAV is the values we receive from the underlying funds. We do not make our own valuations. We add together the valuations we receive from the underlying funds. And they, of course, follow extremely strict and rules for valuations, usually LTM, latest 12 months, EBITDA, and market multiples from comparable companies. So it's an aggregation. And it's a little bit of a lag. When we report Q3, it's based on the underlying funds reports for Q2. So there's a bit of a lag there. You will note that we have over time consistently paid a rather good dividend. And our guiding principle has been to dividend about 4 to 5% of the NAV. We're not so focused on the yield on the share, but we try to. That has been our sort of focus over the years. So this is quite a good return distribution to shareholders, and we have also made quite large distributions through share purchases. So I think if you add share purchases to this, it's probably 25-26 kronor per shares in the last 5 years. So it's a large distribution that we've committed. That, of course, partly explains the nice growth in NAV, that we reduced the number of shares. But we're shareholder-oriented in that respect. And it's worth saying, perhaps, also that out of the 83.38 here, the current NAV, quite a bit of that is cash. I think it's 25-26% is cash. But some of that cash is already earmarked for funds to which we have committed capital, in which we are investing. So it's not all available to invest, but we have a decent balance now between cash promises that we've made to pay out and available funds for new investments. So, how are we doing on the stock market? Well, we should be doing better. If we look at the last 2 years, you can see the NAV development on the top end, the top graph, and the share price on the lower graph. And right now, we're trading at a record discount of 26% to the underlying NAV. And I think the share price, when I just looked, was even a little bit lower. So it's maybe 27% now. And I think, Derek, when you calculated our discount 1 year average, it was 18. So we're in a record level there, I think.
Exactly, I think.
Yeah. So what do you get if you invest in NAXS? Well, you get a diversified portfolio in names that you recognize, both when it comes to the funds like Nordic Capital, like Valedo and FSN. You get access to companies that you actually read about, that you will know about, like Best, Joe and the Juice, and so on. And you can read about it in the papers. You can follow NAXS in a different way than you can in many other highly diversified investments. And so here you get the diversified exposure to Nordic buyout. You get a company which has delivered a good NAV development, a good dividend over time, and right now a record high discount. And I know I'm just about to close, but I know when you go home tonight and you have dinner, I recommend that you pass by Bastard Burgers. It's quite close from here. We are also investors in Bastard Burgers. They're absolutely the best burgers. You should buy them with sweet potato pommes frites. That's my recommendation. And then I think we leave it up for you for questions, Derek.
Absolutely. Thank you very much, Thomas and Anne-Marie. I think that was a great summary of what you do. I was wondering if you could expand a bit on the exposure that you get as a shareholder in NAXS. I mean, we went over the funds and a few examples, but could you summarize somehow what you get exposure towards in terms of geographies and sectors?
Right. Okay, I can start there.
Sure.
Thank you, Derek. That's a very good question, because here we highlight some of the brand names that you're very, very well aware of. But our exposure is primarily to the Nordic region, to Nordic buyout funds. But we also have a high exposure to via JAB, JAB, to the global market. And actually, our largest, maybe single sector exposure is to pet care, and pet care including pet insurance. And if you think about pet care right now, people are spending more and more on their pets, and as more and more expensive it gets to get your pet to hospital, the more and more you want to insure it. So our most recent investment was in JAB Pet Insurance, and that they are global number 2, and they're global number 2 also in pet care, pet hospitals and so forth. So that's a major exposure. We also have an exposure to it's primarily Nordic, but that's US, very US-centric. And then through a fund that you don't know that much about at this point in time is Mimir. It's a so-called special situation funds, and through that we get access to it could be engineering companies or distribution companies that you may not have heard about, but they acquire companies that are sort of unfavored or do not belong any longer in the large corporations like Atlas Copco, Stora Enso. And that's also rather major recent exposure for us. We think you will read more about them in the next few years, actually.
But I think more generally, I think the geography, the geographical exposure is mostly the Nordic region. And regarding the funds, we cover all sectors from small cap, mid cap to very large cap like JAB or Nordic Capital.
Great, that sounds like a really good diversification. And on Thomas, you also mentioned that you have a really strong cash position between 25 to 30%. And I know some of this is committed to the existing funds, but could you give some indication of what the outlook for new investments is going forward? I mean, you've invested in the Nordic Capital funds, the sort of new ones coming out, and added JAB and Mimir a lot lately, but is that sort of indicative of what we will see going forward?
We still try. We're very actively looking at new investments in with managers that we're currently invested with, but also new managers. And I think we have a rather good deal flow of what I think we would call slightly more exclusive managers that are perhaps specialized in one way or another, that have a slightly different tack on where to invest. And so I think we'll be back to the market with some news within the next 1 or 2 quarters.
Interesting. And also in terms of the strong cash, I mean, historically you have done quite a few share buybacks, as you mentioned also. And now with the discount at 26 or 27% to NAV, close to historical highs, basically, isn't this a good time to perform additional share buybacks?
Well, I mean, as we mentioned earlier, I think the discount is at or near record levels. And as you know, proceeding to share buybacks ultimately is the board's decision. And it is a fact that the board has in place since the last AGM and almost like every year a mandate to repurchase shares. But there are other considerations than just the discount. I wanted to remember that these depend on our cash position, our deal flow looks like, which where we might allocate money in the short term and so on. But there is a mandate in place, so it will ultimately be up to the board to press a trigger there.
Cool. Yeah, I think we have time for one more, and then I was wondering, you mentioned briefly the direct investments. Some have been co-investments, and some have come about from the funds, so to speak. I mean, you have a pretty wide investment mandate, so should we expect more direct investments, and of what form? Like, could you, for example, be an anchor in a potential IPO or something like that? Is that something that could be on the horizon?
I mean, that's possible. As you mentioned, we have quite a wide mandate, but I think regarding the portion of NAV that we dedicated to direct investment, it will remain very low and close to under 5% like we are now. That's what we expect, at least right now in the short term. And it's very opportunistic, as you see in our existing co-investments. So it could be absolutely in an IPO or outside of an IPO.
Great. Okay, I think that's all we have time for right now. But I want to thank you, NAXS, Marie and Thomas. Great presentation.
Thank you.
Thanks for listening, everybody. Yeah.